All right, welcome back to the deep dive. Today, we're diving into something crucial in the world of finance and accounting, and that is fair value measurement.
Fair value, yeah.
So we're going to try to break down how to figure out, the price of an asset or a liability as
Yeah,
if it were sold between like two really knowledgeable, willing parties.
exactly. We're going to unpack the complexities of that
Yeah.
and how we actually determine that price.
Yeah, and it gets pretty hairy. So
It does.
we have a stack of accounting standards and a bunch of related documents to help us out here. IFRS 13, that's the big one. But I mean, this whole idea didn't just come out of nowhere, right?
Right.
Our sources emphasize that there was, a real need for consistency
Yeah.
in how we're, measuring fair value.
Yeah. So IFRS 13 is the culmination of a collaboration between the IASB, the International Accounting Standards Board, and the FASB, the U.S. Financial Accounting Standards Board.
Right.
They got together and said, listen, we have to get on the same page with this. Before we had things like, SFAS 157 in
Right.
the U.S. and ISO 39 internationally. Those have largely been replaced, of course, by IFRS 9 now. But there were inconsistencies. And so these boards really wanted to create a unified approach. And you can see how important and complex this topic is just by the sheer number of comment letters they received on their initial proposal, 160 comment letters.
Wow.
So that just shows you how much discussion and debate this generated in the professional community.
Yeah, absolutely. So our goal today is to kind of demystify some of this complexity and
Right.
try to give everyone a better understanding of fair value, measurement, what are the basic ideas behind it, and what are some of the practical challenges
Yeah.
when it comes to applying these principles.
Exactly.
So let's jump right in. What are some core ideas that we really need to kind of have in our minds when we're talking about fair value?
Well, the first key is that fair value is what we call an exit price.
Okay.
So it's the price that you would receive to sell an asset, or the price that you would pay to transfer a liability
Right.
in an orderly transaction.
Yeah.
This is not a fire sale.
Yeah.
This is a regular, market transaction,
Right.
not a distressed sale.
Yeah, so it's not like I'm desperate to get rid of this thing.
Exactly.
So I'll take whatever I can get.
Sure.
It's like a normal
Normal.
market. Okay. And then kind of tied to that is this idea of the market participant perspective.
Absolutely. And this is where it gets interesting because you're not thinking about your own specific intentions or situation as the company. You have to put yourself in the shoes of those knowledgeable, willing buyers and sellers in the market.
Right.
And what would they assume? How would they act? What's in their economic best interest? So your plans, for example, to hold an asset long-term or settle a liability early,
Right.
those don't really factor into the calculation.
That makes sense. It's like a hypothetical, almost like a theoretical
Yeah.
market.
Yeah.
Okay. And you mentioned orderly transaction. What does that mean? Like, what are the conditions?
An orderly transaction just means it's not forced.
Okay.
It's not under duress. But, and this is an important nuance, if there are distressed sellers, in the market,
Right.
their actions can absolutely influence those market prices, which would then be reflected in the price you use for an orderly transaction.
Mhm.
So you can't just ignore what's going on in the market.
Got it. So like the broader market conditions, even though this specific transaction isn't a
Yeah.
forced sale,
Correct.
it still matters.
Matters a lot.
And when we're talking about a market,
Yeah.
I mean, there are lots of places, right, where an asset or liability could be traded. So how do we figure out which market to look at?
Great question.
Hmm.
IFRS 13 lays out some guidance on that. They talk about the principal market. So this is the market with the greatest volume and level of activity
Okay.
for that particular asset or liability.
Yeah.
Now, if a principal market doesn't exist, then you look at what's called the most advantageous market.
Mhm.
And this is the market that would maximize your proceeds if you're selling an asset
Okay.
or minimize your cost if you're transferring a liability. But it's after considering things like transaction costs and transportation costs,
Okay.
because those are important.
So it's almost like finding the best case scenario
Yeah.
in a realistic market.
Exactly. It's not just theoretical, it's realistic.
Yeah.
But it's important to clarify that while we consider transaction costs
Okay.
and transportation costs to identify this most advantageous market,
Right.
those transaction costs themselves are not part of the fair value measurement. They're accounted for separately.
Okay.
Transportation costs, on the other hand, can be included if the location is a key characteristic. Think about oil, right?
Yeah.
Location matters for oil because transportation costs are a factor.
So that actually changes the inherent value of the asset.
Absolutely.
Okay, so the costs of getting into the market
Right.
don't affect the fair value itself. But if it's something that's like inherently part of the asset's value,
Yeah.
then we do factor that in.
Exactly.
Okay, so we've kind of set the scene. Now let's talk about specific assets. You mentioned non-financial assets earlier.
Yeah.
Things like buildings and machinery.
Right.
How does fair value work with those?
Yeah. For non-financial assets, it's all about the highest and best use.
Okay.
The fair value is based on how a market participant would use that asset to generate the most value,
Okay.
even if that's not how the current owner is using it. And that use could be standalone, or it could be in combination with other assets and liabilities, like as part of a whole business.
Okay, so let's say I have a plot of land, right, and it's in a commercially zoned area, but I'm
Yeah.
just using it for a garden.
Right.
Like, would its fair value be based on what it could be as a commercial development?
That's the principle.
Yeah.
Now, applying it in practice
Right.
is where the challenge comes in, as our sources highlight.
Mm-hmm.
Because you have to figure out which uses are actually legally permissible, physically possible, financially feasible, and you have to think like a market participant.
Right.
And there can be a lot of debate about how much evidence you need to support a particular highest and best use.
Yeah.
Just because something is legally allowed doesn't necessarily mean it's the best use from an economic standpoint.
It sounds like there's a lot of judgment calls involved.
There is.
Now, what about liabilities?
Yeah.
What we owe to others? How do we figure out their fair value?
So the fair value of a liability reflects the risk that you're not going to fulfill that obligation.
Uh-huh.
We call that non-performance risk. And a big part of that is the entity's own credit risk, their credit standing.
Right.
A company with a lower credit rating, they might have a higher fair value for their debt because there's more risk, that they won't be able to pay it back.
So if my company's, doing better financially or worse,
Yeah,
the fair value of our debt could change even though we owe the same amount.
precisely. And there's a big assumption at play here. When we measure the fair value of a liability,
Okay.
we assume that that non-performance risk is the same before and after a hypothetical transfer of that liability.
Okay.
Now, the ISSB acknowledges that, in the real world,
Yeah.
the original entity and whoever takes on that liability might have totally different credit standings.
Right, yeah.
But for the purpose of measurement, we keep that risk constant.
That sounds a little counterintuitive. Why assume that it stays the same?
Well, the idea is to isolate the fair value of the liability itself in the
Okay.
market. If we started factoring in the credit risk of every potential, transferee,
Right.
it would just get too complex.
Yeah.
And then it wouldn't be comparable.
Okay.
Think of it like valuing a coupon payment on a bond. The value of that promise doesn't change just because a, more or less creditworthy entity might end up holding that bond.
Right.
Their risk of receiving it might change.
Yeah.
But the fair value of the obligation itself, that's what we're after.
That makes sense. Okay, so we're kind of isolating the inherent risk. Okay, cool. Now, our outline mentions something called the fair value hierarchy.
Yes,
It sounds like a way to rank the inputs that we're using to determine these values.
it is. The fair value hierarchy is a 3-level system that helps you prioritize the different inputs to your valuation based on how observable they are in the market.
So level 1 being the most reliable information, I assume.
Level 1, absolutely.
Mm-hmm.
Those are the unadjusted quoted prices
Okay.
for identical assets or liabilities that are trading in active markets.
Got it.
Think about the price of, a share of Apple stock on the NASDAQ Q.
Right.
Generally, you just use those prices directly. There's no need for adjustments. There are a few exceptions, though. Like, what if you have a massive block of shares?
Yeah.
If you try to sell all of them at once, it could flood the market.
Right.
And the price would drop.
Yeah.
Or what if something huge happened after the market closed that
Right.
clearly changed the value?
Okay.
But generally, level 1, think direct, reliable market price.
That's the gold standard.
It is.
What about level 2?
Level 2 is still observable, but it's not a quoted price for an identical item in an active market.
Okay.
This could be prices for similar assets or liabilities,
Right.
interest rates, yield curves, implied volatilities, credit spreads, inputs that have been corroborated by market data.
Okay.
So, for example, maybe you have a bond that isn't traded as frequently,
Right.
but you can kind of benchmark its value
Mm.
against similar bonds that are very actively traded.
Yeah.
So you're using related market information,
Okay.
but you might have to adjust it a bit.
Right.
to make it fit this specific asset or liability that you're trying to value.
And that makes sense. Okay, so we've got the gold standard, we've got kind of the related information.
Yeah.
Now we're at level 3. This is where things get a little more, I guess, estimation-based.
Level 3, this is where we get into the unobservable inputs.
Hmm.
And these reflect your own assumptions as the entity about what market participants would use to price the asset or liability. And you use these unobservable inputs when you just don't have any observable ones.
Right.
This often happens for assets or liabilities
Mm-hmm.
that are really unique or maybe not traded very often.
Yeah.
So it's management's best guess
Okay.
when you don't have a clear market price to look at.
So we're trying to put ourselves in the shoes of a market participant, but
Right.
there just isn't a market.
Yeah. And this is where it gets really subjective,
Yeah.
which is why level 3 gets so much scrutiny.
Right, because it's based on your assumptions, your models.
It is.
And it's not as,
Yeah.
grounded in
Right.
real market data.
Exactly. And just to be clear, the level in the hierarchy, it's determined by the lowest level input that is significant to the entire measurement.
Okay.
So even if you're using some level 1 inputs,
Yeah.
if there's a level 3 input that's really important to the overall valuation, the whole thing gets classified as level 3.
Okay, got it.
And our sources indicate that figuring out the observability and the significance of these inputs, it can be tricky.
Yeah.
And then all the extra disclosure requirements for level 3, it just adds more pressure.
Right, because investors and regulators are going to be looking at those more closely.
Absolutely.
Because they are based on more assumptions.
Much more.
Okay. So now we've got our inputs, right? We've got our hierarchy figured out. How do we actually calculate this fair value? What are the main techniques?
So IFRS 13 talks about 3 main valuation approaches.
Okay.
First, you've got the market approach.
Yeah.
And this is using prices and other relevant information from transactions that involve either identical or comparable assets and liabilities.
Okay, so like if I'm trying to value an apartment building, I might look at
Yeah.
recent sales of similar buildings in the same area.
Exactly, finding comps, like you said, in the real estate world.
Exactly.
So that's the market approach.
Okay. Number 2.
Number 2 is the cost approach. And this reflects how much it would cost to replace the service capacity of an asset.
Okay.
This is often used for, tangible assets.
Yeah.
And the idea is that a market participant wouldn't pay more for something than it would cost to just go out and build or buy a similar one.
Yeah.
So the replacement cost, it acts as a kind of ceiling on the fair value.
Okay. And then number 3.
Number 3 is the income approach.
Right.
And this involves converting future amounts like cash flows, income, expenses,
Yeah.
into a single present value.
Okay.
So techniques here include discounted cash flow analysis,
Yeah.
option pricing models, multi-period excess earnings method.
Wow. Okay.
It gets a little complex,
Yeah.
but the basic principle is what would a market participant be willing to pay today
Right.
for the expected future benefits or obligations if it's a liability
Yeah.
of that asset or liability?
Okay. So it seems like there are different tools in the toolbox,
There are.
and you use whatever's appropriate for the situation. Is there one that's preferred, or is it really just situational?
IFRS 13 doesn't really say one is better than the other.
Okay.
It's all about what's appropriate in the circumstances.
Right.
But the overall goal is always to maximize the use of observable inputs and minimize the use of those unobservable ones.
Yeah.
And sometimes using multiple approaches can give you a more robust estimate.
Okay.
So you might actually use 2 or 3 of them in combination.
Okay. And what happens when you have like a range of prices in the market?
Yeah.
Like a bid price, what
And-
someone's willing to pay, and an ask price, what someone's willing to sell for.
Right, that bid-ask spread. So when you have a spread like that, you use the price within that spread that makes the most sense
Okay.
given the specific circumstances. You could use the bid for assets
Okay.
and the ask for liabilities.
Right.
It's allowed, it's a practical expedient, but it's not a hard and fast rule.
Got it.
You might also use something like a mid-market price, if that's what people in that market typically use.
Right. Okay. And when we first recognize a new asset or liability,
Yeah.
we put it on the books for the first time.
Right.
How do we figure out the fair value at that initial point?
So usually the transaction price, what you pay to receive, that's your fair value at initial recognition,
Okay.
unless there's a good reason to think otherwise.
But not always.
Not always.
When would it not be the fair value?
So if the transaction didn't happen in the principal market,
Okay.
or if it involved related parties,
Right.
the transaction price might not be reliable.
Yeah.
In those cases, you might have to use some of those other valuation techniques
Yeah.
right from the start.
Okay.
And that could lead to what's called a day one gain or loss,
Right.
which is the difference between that transaction price and the fair value you calculate.
That sounds a little tricky, like you just got this thing,
It can be.
and you're already saying you made a profit or a loss.
Yeah. And IFRS actually puts some limits on that.
Yeah. Okay.
For financial instruments, you can generally only recognize a day one gain or loss
Okay.
if the fair value is based on level one inputs
Right.
or techniques that only use observable market data.
Got it.
So it has to be really solid evidence.
So it's not just based on my model or my assumptions.
Right.
It's actually tied to real market data.
Exactly. And that makes sense because, think about it. You just bought or sold this thing. So your model for valuing it,
Right.
it might need a little tweaking, a little calibration to make sure it's lining up with the actual market price.
Okay. And that calibration is basically just making sure that those assumptions are
Yeah.
lining up with reality.
Exactly. It gives you more confidence in your ongoing measurements.
Okay. That makes sense. Now, we've talked a lot about individual assets and liabilities, but what if
Yeah.
we're managing a whole bunch of them together?
Yeah.
Like a whole portfolio?
Right, like a portfolio of financial instruments. So there's actually a portfolio exception that lets you measure the fair value
Okay.
based on your net exposure
Okay.
to certain market or credit risks
Yeah.
instead of valuing each thing separately.
Okay.
And this is allowed when you're managing those instruments on a net basis.
So, like, if I'm using a bunch of different bonds and swaps
Yeah.
to hedge my interest rate risk,
Right.
I can look at the fair value of that whole strategy.
Exactly. It simplifies things.
Okay.
And it better reflects how you're actually managing that risk.
Makes sense. Now, we figured out how to measure fair value.
Right.
But what about telling other people,
Yeah.
investors, stakeholders,
Yeah.
what kind of disclosures are required?
So the disclosures, they depend on which level of the hierarchy your measurement falls into.
Okay.
Level 3 measurements, because they rely the most on unobservable inputs and your judgment,
Right.
they require the most disclosures. So anyone looking at a company's financials, level 3 is where you really want to pay close attention.
And what kind of extra information do companies have to give for those level 3 valuations?
So they need to give quantitative information about those significant unobservable inputs
Okay.
that they used in their models. They have to show how those level 3 balances changed
Right.
from the beginning to the end of the period.
Okay.
They need to describe their valuation process, and they need to talk about how sensitive the measurement is
Right.
to changes in those unobservable inputs.
Yeah.
And for financial instruments that are, recurring level 3 measurements,
Yeah.
they also might have to disclose quantitative sensitivity information
Okay.
if there are other assumptions that could significantly change the value.
So they're really trying to be transparent
Transparency is key.
and give investors insight into those more subjective valuations.
That's the idea. Now, our sources do point out that there's been a lot of discussion about whether these detailed disclosures, especially for those interim financial statements,
Yeah.
are always worth the cost and effort.
Okay.
Some people find them really useful.
Right.
Others question whether the information is really that valuable, especially if it's pretty generic across different companies.
Yeah.
So it's a tough balance
It is.
between giving enough information but not overwhelming people.
Right. Now, we've talked about specific assets in our outline.
Yeah.
Let's start with investments
Okay.
and subsidiaries, joint ventures, and associates.
Right.
How do we figure out fair value in those cases?
So this has been a big area of debate.
Okay.
The question is, should the fair value of your investment just be the quoted market price per share times the number of shares you own?
Right.
Or should you adjust that for things like control premiums, synergies, market liquidity,
Okay.
especially when there are quoted prices out there?
Yeah, so if I own a controlling interest in a public company,
Right.
the fair value of my investment might be higher than just the sum of the share prices because I have that control.
That's the argument. And the IASB, they actually put out a proposal saying that for these kinds of investments,
Okay.
fair value should just be that price times quantity, no adjustments.
Okay.
But a lot of people push back on that.
Yeah.
They said it wouldn't accurately reflect the true value from a market participant perspective
Right.
because it ignores the control, the synergies, all those things a buyer might be willing to pay extra for.
Yeah.
So this is an area where we still need clearer guidance.
Okay. What about biological assets?
Right.
Like, livestock, crops?
Biological assets, that's another area that's really tricky
Yeah.
because of the natural changes in growth.
Right.
Measuring their fair value has been, it's been tough,
Yeah.
especially when you're talking about produce.
Right.
It's constantly changing.
Yeah.
So people are really looking for more guidance on that.
And then finally, what about unquoted equity instruments? These are shares in companies that aren't publicly traded.
Right. So you can't just go look up a market price.
Right. So how do we even start figuring out their fair value?
So for unquoted instruments, you often use what are called comparable company valuation multiples.
Okay.
Basically, you look at public companies that are similar to the unquoted one.
Okay.
Same industry, business model, size, all that.
Right.
And you use their market multiples.
Yeah.
Things like price to earnings, enterprise value to EBITDA.
Yeah.
You apply those to the unquoted company's financials.
Okay.
But you also have to make adjustments.
Right.
You have to discount for the lack of liquidity
Yeah.
because it's harder to sell shares in a private company.
Right.
And you might have to discount for lack of control if you only have a minority interest.
Right. So if I don't have the ability to make big decisions,
Right.
then my stake is less valuable.
Exactly. And imagine trying to value a tech startup that isn't even profitable yet. Finding comparable companies, figuring out the right discounts for all the risks.
Yeah.
That's where it gets really judgment intensive.
So this is where those core principles of IFRS 13, the fair value hierarchy,
They all come into play.
all that really comes into play.
Absolutely.
Okay. We've covered so much ground today.
We have.
To wrap it all up, what's been the overall impact of IFRS 13 since it came out?
So the European Financial Reporting Advisory Group, EFRAG,
Okay.
they did an assessment and concluded that IFRS 13 is probably neutral in terms of costs for users,
Okay.
but it's improved consistency
Yeah.
and how people understand fair value measurements
Right.
across different companies and industries. Now, they do acknowledge that some entities probably had some upfront costs,
Right.
changing their systems,
Mhm.
getting everything in line with the new requirements.
Yeah.
But the big benefit is comparability,
Right.
transparency,
Right.
and giving people the information they need to make decisions.
Yeah.
And most people agree that that outweighs those initial costs.
So it's kind of like a trade-off, right?
It is.
We're getting a more standardized,
Yeah.
market-reflective view,
Yeah.
even if it takes some work to get there.
Fair value measurement is a complex topic, but it's a really crucial part of modern financial reporting.
Yeah.
It tries to capture what those assets and liabilities are actually worth in the market
Right.
at a specific point in time.
And it really highlights, how important it is to understand that hierarchy of inputs
Flexible, yeah.
and all the judgment calls
Yeah.
that can go into those level 3 valuations.
Especially level 3.
So here's something to think about for all our listeners out there.
Right.
Given how much judgment is involved in this,
Yeah.
especially for those assets and liabilities that aren't traded all the time,
Right.
how confident can investors really be in these fair values that are reported?
That's the big question.
What are the questions they should be asking companies, auditors, and even themselves to make sure that those fair values are reliable and really reflect what's going on?
Because transparency, good auditing,
Yeah.
strong corporate governance, those are all essential
Yeah.
to making sure that those fair value measurements are credible.
Definitely something to keep in mind as you're looking through those financial statements.
Absolutely.
All right. Thanks for joining us on the deep dive.
Always a pleasure.
We'll see you next time.
See you then.